Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, August 23rd, 2022, and I'm pre-recording this Trading Places Live for just a bit later this morning. Currently, futures are relatively flat, up slightly. They've been up most of the night. They were up a little bit more than they are now. They dropped back close to the even line. Now they're starting to increase a little bit. We still have a couple of hours to go before the opening bell, though. Currently, futures, Dow futures up 22, S&P 500 futures up 4, NASDAQ futures up 19. So on a relative basis, seeing a little strength in the NASDAQ. This comes after the worst day that we've seen since June on all of our major indices. So it was a really rough day yesterday, but it was the Monday after options expiration. I warned earningsbeats.com members this is the worst day of the month historically, the Monday after options expiration, and it certainly lived up to that yesterday. But as we go forward, we've got some things to look at. We'll be getting into all that in just a little bit. I did want to mention crude oil prices up about $1.50 this morning, near $92 a barrel. 10-year Treasury yield down 2 basis points, but still hovering just above that 3% level, 3.01%. All right, before we get into anything today, let me first just go through the agenda with you. I'm going to start off with the daily market recap, jump into talking technically. Then I'm going to look at the S&P 500, take a look back over the last month or so, see what's been doing well, what hasn't been doing well, pull up some charts, look at a little price support and resistance, show you what I look for. Then we're going to jump into tips and tricks. So take a look at just a couple of things that you can do at StockCharts. Some of this I kind of take for granted, but maybe it will help some of you. So we'll go through and we'll do that. Then earnings spotlight, we'll wrap up with the 3 you must see. But first, for those of you that are new to Trading Places Live and you're not familiar with Earnings Beats, if you go over to earningsbeats.com, this is the best way to get more familiar with us and what we do. If you scroll down, we have a free newsletter you can sign up for. That's our EB Digest, comes out Mondays, Wednesdays, Fridays. It's a very quick read, just a couple of paragraphs and a chart. All you need to do is sign up with your name, email address, hit that subscribe button. We'll make sure you get set up. Also, if you would like to join us, we have a huge event coming up this Saturday. Anybody who registers here, if you're not already on our EB Digest, we'll make sure you get added. And of course, you can unsubscribe at any time. No feelings will be hurt there. I think you'll enjoy the newsletter, though. I think there will be some trading opportunities, hopefully some education, things, way we look at the market. And hopefully maybe that'll translate into something that can help you in your trading. But anyhow, this Saturday morning at 10 a.m., this is a free virtual event. You've got to register in order to save your seat, to get your invitation to come into the event. But I think it's going to be maybe the best event of the year. Our Market Vision events have been spectacular. This one will be similar to the Market Vision events that we do at the beginning of the year. This one, of course, this Saturday, covering the balance of this year and into the early part of 2023. So I'm going to be giving my outlook. I'll go through everything, show you what I'm looking at, why I'm concerned about certain things, why I might be bullish on other things. But make sure you tune in for this. In order to do that, though, you do need to register. So make sure you go over to earningsbeats.com and follow that link and register. So looking at the action from Monday, it was a rough Monday after options expiration Friday. And this is typically a bad day for the market. And if you're wondering why would it drag on to the week after options expiration? Because I talk a lot about options expiration week. And last week, there was a ton of in-the-money call premium, meaning that as the market just kept going up, 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 a lot of retail traders were buying calls. And even the ones that were buying puts, as the market kept going up, the puts were no longer in the money. So the only thing that mattered were all those in-the-money calls. And how do you get rid of in-the-money call premium? Well, prices need to drop. And so that's the problem most of the time with options expiration week and into the first couple of days of the following week. And I'll explain that in just a minute. But the stock market historically goes up from the 11th to the 18th of calendar months, all calendar months. That's just a period of time where historically the stock market has done better than normal. And I think a lot of it has to do with money flow, but I'll save that for another day. 11th to the 18th does very well. Well, Friday, the third Friday of every month, is monthly option expiration Friday. And the third Friday of every month has to fall between the 15th and the 21st. The third Friday cannot be before the 15th. It can't be after the 21st. The Mondays that follow then have to be somewhere between the 18th and the 24th. If the third Friday has to fall 15th to the 21st, then the Monday following has to be the 18th to the 24th. And so this was Monday, August 22nd. And the problem with options expiration is a lot of times it is in the financial interests of market makers to use their capital, and they've got a lot of capital, to drive prices lower into option expiration week, into option expiration Friday, and into the early part of the following week. So why would it drag on to the following week if options expire Friday? Well, think about it. Let's say you have a call for Apple. You own a call for Apple, and Apple's trading at 168 bucks, and you bought it when Apple was 150, and you bought that call for 160. So you didn't have to pay a whole lot for it. You were $10 out of the money. Well, when you go up to 168, now all of a sudden you're $8 in the money. You made a lot of money, and there's a lot of value in that call because you're $8 in the money. Well, what happens if you decide that you want to exercise your option? Your option gives you the right to purchase Apple at $160 a share. Every call contract gives you the right to purchase 100 shares at 160. Well, if you're $8 in the money and you have one contract, and that's the equivalent of 100 shares, you have $800 worth of value at the time the options expired on Friday. Now, you could have sold that option, basically taking your $800, or you have the right to exercise and buy Apple at $160. Now, the beauty of doing that is you don't have to pay taxes. If you exercise, the cost of your option then goes into the cost of the price of the stock. So if you paid a couple bucks for your option, I don't know what you would have paid for it. If it was 150 when you bought it and it was a 160 contract, maybe you paid $1 for it. I don't know. Well, when you pay 160 to own the stock by exercising your option, you add that dollar cost, and now your cost basis for the stock's 161. You don't have to recognize the gain on that option, which is now the stock, until you sell the stock. That's why a lot of folks will exercise options, because it delays the inevitable tax bill. Well, if you exercise that option and you purchase the stock for 160, who do you think's selling you that stock for 160? Market makers. Now, when you bought the call when it was 151, market makers sold you the call, and if they were smart, they bought the stock at 151. That's a covered call strategy. So that when it does go up to 168 and they want to exercise for 160, the market maker can just simply sell them the stock at 160. And they had bought it back at 151, so they made that money plus, the premium and so forth. So anyway, the market makers are essentially whole until they end up covering their position, because now they've shorted at 160. If you're buying at 160, market makers have to short at 160. Well, the stock's trading at 168. Which way do you think the market makers want price to go heading into option expiration Monday? They still have a financial interest in the stock coming down. That's the incentive for market makers. And that's why the Monday after options expiration tends to be so weak. There's too much money at stake. We're talking billions and billions of dollars that potentially is on the table. So anyway, when I look at the action for Monday, I see this. This is what we talked about at earnings beats beginning of last week. Listen, I was bullish, called the bottom back in June. But from a trading perspective, short-term trading perspective, I turned bearish beginning in last week, cautious, if you will, but I felt like the market would probably pull back because of options expiration. And there it goes to the downside. We didn't quite get as far as we could have based on max pain, but I would still give it a little bit more time. Next day or two, we still could see a little bit of fallout from all of this. Anyway, yesterday, the Dow Jones was down 1.9%, S&P down 2.14%, NASDAQ 2.55%, mid caps 2.17%, small caps 2.25%. All 11 sectors were down, led by communication services, which was down 2.86%, technology 2.79%, discretionary 2.78%, financials 2.20%, and real estate 2.08%. So it was just bad all the way around. You can see many of these different sectors and major indices lost the 20-day moving average. That was the first key area of support. As I looked back, the 20-day moving average, we lost it. I'm looking at some gap support. I'm looking at the last breakout, which would have been above that July high. I'm also looking at on the S&P 500, that psychological level around 4,000, the now rising 50-day moving average. All of this right in here is where I believe we will find ultimate support, if not sooner. If we go back below 4,000, maybe give it that 50-day, which is just below 4,000, and close back below there, then we're going to have to be looking at some additional things to see, okay, is there the potential for more weakness here? Until then, I'm looking at this as an opportunity. So I began yesterday building back. So any of the shorts I had, I covered end of last week. Didn't ride any of them into yesterday, unfortunately. But that was fine. You know, I don't like shorting in what I think is the resumption of a bull market. If it goes down, it goes down. I'm saving money because I'm on the sidelines. I don't really worry about catching every little last drop of the move to the downside. But as it moves lower, and if you did get out beginning part of last week as a trader, now all of a sudden you've got the S&P 500 down 4% from where it was. And I believe using this weakness to build back into positions, whether it's the spider, whether it's the Qs, the QQQ that tracks the NASDAQ 100, whether it's individual stocks, I would be looking for support areas and considering building position over the next couple of days. Let the market do its thing. If you are still short, congratulations. If I was still holding something like the QID, which was the leveraged or is the leveraged ETF that tracks the NASDAQ 100 to the downside at a clip of 2-to-1. So as the NASDAQ 100 drops 1%, the QID goes up 2%. The beauty of that, well, there's a couple things. Number one, you've got leverage. So you can use, if you so choose, you can use retirement funds, but you don't have to use all your retirement funds. In other words, if you wanted to short put your entire account balance on the short side for just during max pain week, you could do that by simply buying or putting half your account into the QID. That essentially covers your entire account as though it's shorting the NASDAQ 100 in its entirety, the entire balance of the account. Hopefully you understand what I'm saying. And the reason I like to do that sometimes is that I still have funds in my retirement account, 50% of the funds, because there are other ways to short the S&P and the NASDAQ without using the leverage. For instance, on the S&P 500, I think the ticker symbol is SH. So if you buy the SH, you're effectively shorting. So if the S&P goes down 1%, SH goes up 1%. Well, you could put your entire account in the SH. The problem is when you decide to sell, you got to wait 2 days for your funds to settle. Or if you do buy, you have to wait for everything to settle before you sell the SH. So if you get into the SH and then all of a sudden the market takes back off to the upside and you want to get out, you're stuck unless you want that free riding violation. And then they start restricting the way you trade in your retirement account. So anyway, using these leveraged ETFs is one way to get around that, because you can put half your account to work and you still have half your account sitting in cash. Anyway, just thought I'd mention that. But overall, yeah, the action not very good, but it was option expiration week yesterday, the Monday after. I think the next couple of days, I'd like to see a reversal. That would make me feel better. But if I was still sitting in the QID, my point was, we've now gone 4 days in a row with lower lows and lower highs. As long as that continues, you could stay with what you have. But the first sign of a reversal back to the upside, and I'd cover or close out any short positions I had. That's just my preference, because I believe we're going back to the upside. But if you're in on the short side, you can ride this as long as it lasts. No problem with that. Anyway, all of the aggressive groups led to the downside. But again, that makes sense. These are the groups that were more heavily traded in options. These did the same thing back in March to the upside. You know, a lot of folks were thinking that's it. Bear market was over, or the correction was over back late March, mid-March, when we went through options expiration. And I said back then, I thought it was Max Payne related. I did not think that the bottom was in on the market. We turned around, went back to the downside. I'm going to say the same thing this time, except flip. I don't believe we're going back down anywhere near where we were back in June. I think this weakness right here is related to options. We'll see. Let's see what happens. Let's get past the next day or two, and then let's see how the market closes out August and starts September. I think we're going to be moving back to the upside. All right, 10-year Treasury yield. Well, this morning did see it down. Right now it's down 2 basis points, 3.02%. We have been trending higher, though, again. I just think we're more, honestly, in a trendless environment at this point. We were in a nice trend, went up 3.48. I thought we were starting this downtrend, and it certainly looked like it until early part of August. And now we've moved back up through the moving averages. That's not the way a downtrend goes. So now we've got this below the moving averages, above the moving averages, below, above, back down below. Now we're back up above. To me, this is trendless. When you're not following the moving averages, when you're just going up and down, above and below, that is kind of the hallmark of a trendless environment. So at this point, I would just say we're, trending sideways. I do think ultimately we go back to the downside in the 10-year Treasury yield. A lot of folks disagree with me. And if you think that inflation remains a problem, is going to continue to be a problem, and the Fed's going to remain hawkish into 2023, then I think you'll probably see that 10-year Treasury yield keep going higher. I just don't agree with that scenario. I think eventually the Fed is going to actually begin to lower rates, not hike them. I think that could occur later this year, if not, perhaps beginning of next year. We're already seeing an inventory build. I think there's going to be talk of deflation. Probably within the next couple of months, I think we're going to start hearing about the possibility of deflation, and I think the Fed will pivot. We'll see. All right, let's move on. Let's talk a little bit about talking technically. First thing, always like to start with the S&P, and you can see there it is, the break below the 20-day moving average. Now, there are a few things that I would look for on this chart. The first thing that I saw when I looked here was this gap support over here, just this little gap up right here. And so we had this area of gap support that we're currently sitting in. I don't know if it holds, but if I was building a position in the spider, I certainly would take an initial position here. The next stop that I see is probably down. Well, I'm going to give a couple of levels. Right here on the way up. Right here on the way up, we broke out above 4,100. Notice the pullback came to about maybe just under 4,100. And then we gapped up just a little bit the next day. We've never filled that gap. So there's another unfilled gap right there. And then you see this breakout above this prior high. That is kind of like my final line in the sand in terms of price action. The other thing that you could do is draw a channel. And once I get a bottom formed and I start moving up, I've already had a couple of pretty important lines, highs established. So this is kind of giving me a channel, at least in the short term. And then what I would do is come down and connect the low here, which is right here. That's the lowest candle body. I mean, you could do the candles, do the intraday. I usually try to connect the candle bodies. I guess it's all just preference. But anyway, if I connect that low from connecting the highs, there's the channel. That comes in right now at about 40.50. So this is why I think we have this range right in here. If we lose 4,000, especially the 50-day moving average, at that point, we will have lost a lot of different support areas. And then you have to go back and reevaluate your position, whether you like it or not, whether you have a bullish bias or not. You still have to evaluate when you start to lose that many technical levels. And I will, but I don't think we're going to lose them. We'll see. I think we're probably going to go down maybe another couple percent, maybe. I think we could test this trend line. This trend line keeps coming up, by the way. So it'll move higher right into the rest of this week. But if we were to move down another 1.5%, 2%, we'd be getting pretty close to that level. That's kind of what I'm going to be looking at. And I'll be basing some of my buy decisions on this channel that I think is, at least in the short term, going to provide us some support. What else do we have? I wanted to show you. Let's move on to the S&P 500 components. Just talked about the S&P 500, but let's take a look at the components and see what we have going here. So we've got the worst performers. I've got this set up over a 1-month period. And so this gives us the worst performers over the last month. And then down at the bottom, as you go down, you'll get toward the best performers. So what I wanted to do is just go through and just point out, when I look at these, again, this is the worst performer in the S&P 500 over the last month. And you can see it's not pretty. Now, here was a gap down. We moved down, started to bounce a little bit off of it, maybe a little bit of a bear flag or maybe even a little wedge. But that broke and we went back down and we cleared this prior low. So to me, DXC is in breakdown territory. I mean, I don't see anything exciting about this chart at all. Would have no interest in it. The next one on this list, Stanley Black & Decker. This one's kind of interesting. I'm going to annotate this, just show you how I would approach a stock like this. After the big gap down, it keeps moving down. When it rallies back, one level that I would watch would be this level right here. And the reason, this was probably earnings related. So we've got new fundamental information. The stock gaps down and then intraday makes its way back to 105. And at that point, all the selling really kicks in at 105. So if I make my way back toward 105 again, that's where all the selling was. That's your key resistance. And look at what SWK did here. Didn't quite get to 105, but pretty darn close before rolling back over to the downside. So that's kind of how I look at price support and resistance. If I know I've got new information, how does it trade? I mean, you might say, well, yeah, it's got to go fill the gap. Well, no, because now it's got new information. A lot of times they don't go back and fill that gap. Maybe many months down the road, but not initially, not with this kind of volume coming in. And with that reversal, I would not be looking for 117 or 118. 105, if I was going to short the stock, that's what I would be looking at. Fortinet, this is a software company that clearly has been under having some issues, because remember, the market bottomed back in mid-June, and we're below where we were then. So this stock is not participating. Here's the low. It certainly seems like 48.75, 49 is where we're headed on Fortinet. Now, if I flip this and look at the ones that are doing well, I can then pull up Enphase Energy, which is, up 32%. You can kind of see a little different chart here. I actually like this 20-day test, but the gap support zone from 258 up to 270, that would kind of be the area where I'd like to accumulate. Yesterday, we went down right almost to the top of that. You could do the 20-day. I mean, I'd be okay with initial entry at the 20, but I'd be at least leaving some powder dry for this gap support area. And then you take the next look at the next one. This is a utility company, AES. Beautiful move up. Where'd the failure come? Right at 26. I think we might see a 20-day test here. Anything back down the 20-day would be interesting. That's the way that I would tend to look at these stocks. I mean, if I got an uptrend, I'm looking for key support. I'm looking for rising moving averages. If I've got a big downtrend, pay attention when you do have these earnings, moves. And I don't know if this was an earnings move on AES or not. Very similar to one I just showed you earlier, except it reversed back in the other direction, gapped up, pulled back, and now this becomes a major support, and maybe even $22 if we were to get back down there would hold. So definitely look at these differently based on how they trade with new fundamental information out. All right, I want to show you just a couple of tricks real quick. First one, how do you display average volume? See, here's volume on the chart, but this is showing it under the chart attributes. You can't get average volume here. What you have to do is you have to turn this off, and you have to go down here and under indicators, pull up volume as an indicator. And then you can come over here and put in an overlay, simple moving average 50-day. And when you do that, now you've got volume down here, and you've got the 50-day moving average, and you can see whether or not you're trading above or below that each day. So that's one quick trick. And then the other one I wanted to show you was, let's say you wanted to change the way the look of a chart list. So let's just take this particular chart list, which just has a bunch of technology stocks in it. And let's say I wanted to change this format here, and I wanted to do it for all the charts. Now I could do it individually for each stock, but I want to do it for all of them at the same time. Well, one thing I like to do is just set up another chart list just in case I screw up. So what I might do is set up a new list and go 0108 1, the most overlooked technology. Just leave it at that. So it's kind of the same name. But now what I will do is go back into this other one and select all. And I'm going to copy all the charts, and I'm going to put them in another chart list. This way, if I screw it up, I haven't screwed up my main chart list, right? So I'm going to put them into this new chart list. Now I got to make sure I go into the new chart list, pull them up. I'll pull up one of the stocks in here. And now let's say the one thing I wanted to do was to get the RSI on here instead of the accumulation distribution. So I'm going to do this. I'm going to pull the RSI up. I'm going to update this. And now if I go to the next chart, you'll see that right now it still has the AD line. If I go back to the one I just changed, it has the RSI. Now what I can do is I can say, apply this style to all. And then I go to the next chart, and there it is. So all of them got changed at once. Last thing I want to do real quick, let me see. There was earnings spotlight. Really the big one I want to show you here is Zoom. Zoom down $10 this morning, 11%, not doing well. Palo Alto Network's having a pretty good time. 3 you must see real quick. Shockwave, S-Wave, I don't like that false breakout yesterday. Perhaps we see a little bit of a pullback off of that. KC Stores, CASY, I don't like that reversing candle. I think the stock looks pretty good, but I wouldn't be surprised to see a little short-term weakness. And then NSSC, this stock doesn't trade much volume, but I do not like that reversal right there. And if you look at the PPO, very bad negative divergence with a reversing candle. Be careful here, folks. Anyway, that's it for me. I appreciate you tuning in. Have a great rest of your day. I'll be back over at Earnings Beats on Wednesday morning for your next Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.